Look, let's face it, you're probably in this loop right now as we speak. And it's called the trading failure loop. You're watching every single YouTube video, doing every course, joining every mentorship, every signal group that you can. You're trying to do copy-paste strategy, whether it's copy-paste trading through signals, whether it's simply taking someone's strategy and trying to copy it. You're doing this without actually knowing what they're actually doing. And so you're just trying to guess your way through it. But then you wonder why it never works. And what do? Next? You give up. It's a cycle. It's a loop. The trading failure loop. And guys, the reason that you're in this loop, it's not your fault. In fact, it's probably one of the best things you could do if you're starting again from zero. But unfortunately, it's not going to make you profitable at all. That's the truth. So what can you do? How can you actually become a profitable day trader? Well, let me show you a strategy you can use. You're learning a proven, simple framework that makes sense on an institutional level. It doesn't involve luck, hype, or chasing signals, which doesn't wait for 10 or more confirmations to enter the market, and which doesn't predict but analyzes the market and where it's looking to go. And guys, it's the same framework that got me from a broke construction worker with $250K in debt. That's me broke, smiling but not happy, to becoming a multi-millionaire trader that has time, location, and financial freedom. It's called the liquidity trap. So, how does it work? First, we need to understand what we need to make this work. Remembering that it takes time and consistency. Nothing will ever be an overnight success, especially in the trading space. Remembering that you're trading against the majority of retail traders and with the big money that is truly moving the markets to hunt liquidity. You're going to use every time frame from the weekly down to the 1 minute time frame. So your daily, your 4 hour, your hourly, your 30 and your 15, your 5 and your 1. Know your sessions as well. Know when the market is most volatile, London Open, New York Open. Know as well that you can trade during any session. There are peak times in the market where if we can be on the charts, we should be. And then obviously knowing your trading view tools, your horizontal lines, your boxes, and that sort of thing. 2 is your weekly and daily bias. So what do we do? First, we want to mark out your major highs and lows. So your all-time highs and lows, your swing points. Again, highs and lows are going to also line up a lot of the time with equal highs, relative equal highs and lows, resistance levels, support levels, and things of this nature. Ask yourself, before getting into a trade or before looking at a bias on a weekly and a daily perspective, where would the big traders' stop losses be? It'll be above resistance, below support, at significant highs and lows. Then what we want to do is mark out our breaks of structure and our supply and demand zones. Supply and demand zones is basically the last push before a big move up. When price returns there, break and retest, supply and demand, support and resistance is all the same thing. They're looking for an entry. Spot crowd behavior. Selling into resistance, buying into a support level. This is where most people are getting into trades, and a lot of the time into trades with the same direction as other strategies. Number 3 is you want to build an intraday plan. So on the 4 hour, you want to remark your swings and equal highs and lows. Also your structure, and check if any sweeps of that have already happened. They have? Great. It could add to your confirmation zones. On the 1 hour, you want to mark out key support and resistance that traders will pile into trades at. Of course, if we have a resistance level that lines up with the supply zone, there's going to be a lot of traders selling there. So we want to mark that out as a key area where there's a lot of liquidity above those zones. Could also be a significant high there. Significant high, resistance level, supply zone. Could even be a trend line buildup, which we want to look to target that. So we know there's a lot of liquidity there. Number 4 is identifying the trap zone. So again, what is a liquidity trap? First, we need to understand the engineered moves. So basically, liquidity traps are engineered moves which bait retail traders to get into a trade in one direction. So the institutions can fill their orders and move price in the opposite side and take all that liquidity. So you want to look for obvious crowd levels. So things like equal highs and lows, things like obvious support and resistance levels, and false breakouts or fake breaker structures, which are sort of considered like stop hunts or traps in the market. Number 5 is the institutional entry. So you want to wait for the sweep. There'll be a stop run above highs or below lows. You want to look for a counter breaker structure or breaker structure in the opposite direction to try to make sure that everyone that hasn't jumped in yet but is waiting to are about to jump into a trade. All in one direction, we want it to go the other. So the entry is a retest of a flip zone or price taking out a small support level. Your stop loss, you want to put that just beyond the sweep extreme. And your target is the next liquidity pull. So let me show you my exact thought process behind the actual entry model, which I've just spoken about, this institutional entry and how it works. So here we have the 1 minute time frame. This is a trade that I actually caught. So first thing we want to do is mark out your structure. So we have a big break of structure here. So you know what, we'll go down to the 15 just to mark this structure point before moving on. So what can we see here? Well, price has a big rally from this low and then pulls back. After this pullback, it begins to rally towards the previous high, again, where the liquidity is lying. Great. So there's your previous high. We then have a big push up, creating a break of structure of that high. So 15-minute range is actually bullish, and it's bullish between this low and this high is the trading range. So what do we notice now? Well, obviously we have a demand zone where price comes back into. If we look and pull out our Fibonacci tool from this low to high, we can see that price is around about that 61.8 retracement level, which is considered their golden zone. So we know that Fibonacci traders are going to buy around here. Supply and demand traders are also going to buy around here. And you've got your support and resistance traders in the market as well. Where are the support traders buying? Well, if we drag this level across, they're also buying in this range. We have a support level which connects all of these wicks and all of this price action here with this wick there where price eventually taps into. So we know, looking at this, that okay, we have a significant high where there's obviously liquidity above a high, but it's already taken the liquidity from a previous high. So will price go to take that high out now? That's what we have to ask ourselves as traders. Well, we want to step back and look at the liquidity. So we have the supply zone, we have the market structure bullish. We know a lot of traders are looking for buys in this area, the Fibonacci zone and the support level as well. So we have several confirmations of why price should actually go lower before it goes higher. Now it's about finding the trap. So in this case, where is the trap here? Well, simply put, price comes down, makes a lower high, makes a lower low, lower high, lower low, higher high. Boom, there it is. As soon as price pulls back, and as soon as price really does this big 1 minute candle here, everyone's piling into positions around this area because they think, based on the break, that the price is going to continue to go higher. So they all jump into their buys there. If we look at what price has actually done, is it's taken out a small resistance zone here. After taking out that small resistance zone, price flips. As soon as price flips, that's when we enter a trade, because even we could have entered on this next candle here. This is the entry. Even though we could have entered on this next candle here, because look how price reacts from this supply demand. Price comes up, reacts off the demand zone, and then wicks up. So everyone's now getting excited. They're all scaling into their buys. They're maybe doubling up on their positions, thinking that price is going to go higher. What does price do? After the flip, we go the opposite way. First step, take out the liquidity of this zone here, which is the 1 minute zone. After that, we could definitely be break even on that trade because now we've taken out the significant liquidity. We could move our stop loss to break even right there. And then price just continued to melt. So by here, I actually went break even personally as it was deep into that deep into the support level and the demand zone. But then price just continued to melt and go to our final target, which was a 1 to 2 on that trade. Guys, super clean, super simple. That's exactly how it's done. On a lower time frame, 15 minute, find the bias, find where price is looking to go, find where the majority of traders are getting in, which was this zone here, wait for the trap, then get into a trade in the other direction. Perfect. Rinse and repeat, take this setup every single day without failure, and you'll see the success of it very, very quickly. But thanks guys. If you liked this, make sure you like, comment and subscribe. I'll see you on the next video. Thank you.